Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. Hopefully I am coming through loud and clear this time. I had a false start. There we go. Looks like we are all set for the Fed press conference, doing some live coverage here with you today. And there is the news. Let me pull it up. Fed leaves the key interest rate and asset purchases unchanged. But just like on CNBC, today we will go through the news. We'll watch the markets as they react. I can't even imagine what's going to happen in silver after what we saw earlier today. And I was having a conversation with someone about how things have gotten so distorted in gold and silver pricing that even if you know what the Fed, even if you knew the Fed was going to launch a new quantitative easing package, you still almost wouldn't have any clue what is actually going to happen to the price of silver because it seemingly continues to be spoofed at any time, any place. But anyway, we will cover and see what happens. We'll get a refresh there, but silver almost back to flat on the day. And as you can see here, Federal Reserve leaves interest rates and asset purchases unchanged. So let's see what happened here. And by the way, I will again mention this is a live call. So get your questions in there. And I'm going to pull that window up in a moment. And but yeah, send your questions in and we'll field those. There we go. I see it. So as we dig into the statement, well, give me a second. Got a couple windows up here, but yeah, we'll dig into that statement. And again, let's get this off the screen. Send in your questions and we will start getting to those shortly. But Federal Reserve kept its foot to the floor Wednesday in terms of the help it is providing for an economy that central bank officials say has slowed down, yet is still at all-time highs, I might add. And we'll take a look at how the bond market is reacting to this as well in just a second. In terms of providing, they say it's slowed down. So I will say that would be a key phrase. The fact that they think it's slowed down. I mean, obviously anyone that reads Austrian economics and has broken through of the Wall Street spell knew the economy has been slowing down for the last 15 years. But when you hear central bankers say it's slowing down, that means there's more money printing on the way. Consistent with market expectations, the policymaking Federal Open Market Committee said it was keeping its benchmark short-term borrowing rate anchored near zero and maintaining. Wait a second, weren't they in the last meeting they were talking about tapering? That was the reason why gold and silver got hammered then. Now it's back to zero. I guess the taper is off. And maintaining an asset purchase program that is seeing the Fed buy at least $120 billion a month. All right, I'm going to get, let's see, 12. I'm going to get 1.44 trillion over the year. Let me check my math. But if we have 120 times 12, thank you, Mrs. Parks, for those third grade multiplication tables. And so that's 1.4 trillion over the year. Keep in mind that former Fed chairwoman Janet Yellen, who's now running the Treasury, has said that it's time for the U.S. to act big. So if we were already on a pace for 1.5 trillion of hyperinflated dollars this year, and now the Fed is going to act big, I mean, you know, we'll see. What are you supposed to think about that one? We'll get back to the announcement, although I do think we will be having a live guest appearance from the great Andy Schectman, perhaps amongst others. So anyway, appreciate your patience, but I think we're about ready to kick in now. So at the core of the move to keep policy historically accommodative was an economy in which most sectors Sectors most vulnerable to the pandemic are taking the hardest hit. The pace of the recovery in economic activity and employment has been moderated in recent months. I wonder what's happening to silver as this is. Okay, silver is just sitting there doing nothing. I mean, this makes me want to buy more silver vol, which is not legal recommended financial advice, but pace of recovery has moderated. COVID causing strain. Otherwise left the statement unchanged. Fed took the rate to 0. So, oh, here we go. Though inflation remains low now, right, what planet you're on, investors worry that the Fed could start to taper the purchases unexpectedly. No, I'm calling BS on that one. Show me the investor that's sitting there worried that the Fed could start to taper purchases unexpectedly. I mean, they telegraph everything months before they do it. I can only imagine which banks get in on that before I find out. So if you find the person who's worried that the Fed's going to unexpectedly taper, please let me know so I can play poker against them or gamble somehow. It's possible. There's no one. No, it's not possible. Statement offered no new guidance. Fed officials remain cautious on an economy that has seen a 2-speed recovery. I love the car metaphors, like they're two-way gears shifting the economy, as if these guys like talk about they're gonna tweak inflation. You know, it's 2% is our target, but it's only 1.88%. So we'll buy just the precise amount of bonds. I mean, it doesn't quite work like that. They can't even measure the inflation that's already happened, let alone anticipate it in the future. Under the approach, the Fed no longer will raise rates in anticipation of inflation, but rather will just tolerate the higher levels in the interest of a more inclusive recovery. Wow. I wonder how many copywriters it takes to come up with this one. In the past, jobs would fall consistent. The Fed would institute preventative hikes to stop inflation in its tracks. I don't see any preventative hikes coming in the near future. But what I could tell you is that Andy James Bond Schechtman has joined me on the line. And while he's logging in there, let's take a look at some of the other markets here. Let's see what is happening in bond land. I mean, essentially, the Fed said nothing, which is par for the course. But Andy, are you there? Can you hear me?
I hear you, Chris. How you doing, my friend?
All right. I guess we do not have Andy quite at the moment. Andy, let me know.
I'm here, Chris.
Andy is logged in there.
Chris, can you hear me?
Andy is talking, but is apparently muted. So we will get that figured out. And Andy, if you can hear me, feel free to join in anytime.
I do hear you, my friend.
Anyway, we'll dig back into the markets here. Let us
Chris,
see.
Can you hear me?
What has happened with the bond market. It was right around 1% and not much movement there. And so far, not a whole ton of activity in silver, sitting there pretty flat. So I guess this is the kind of thing that, I don't know, maybe I am the only one who thinks about this, but this morning you had silver go from 25.40 down to 24.80, below 24.80. Fortunately, I saw that one right this time, and I actually did buy some call options right there, which worked out well. Then it rebounds another 60 cents in about an hour or so. And then when you have the actual meeting, there's no reaction in Silverland. So anyway.
Can you hear me now?
They could hear Andy, although I couldn't.
I'm back, brother. Can you hear me?
Okay. Well, give me 1 second. I figured out the issue here. And bear with me. But yeah, that just always strikes me as odd when you see, such wild movement. earlier in the day. Almost have us set here to go. There was a workout video. I did buy the V-Shred options course. Andy, are you there? Can you say hello?
Hello, my friend. Can you hear me this time?
Andy, I can hear you.
Fantastic.
Got us all set up now, so thank you for the audience for getting that cleared up. And Andy, we just had the Fed meeting. Like usual, they said nothing, but I mean, Janet Yellen is telling us to act big. So any thoughts on the Fed announcement and so far muted market reaction?
No, I mean, look, the blessing in it all is typically when the Fed speaks. Leading up to it, you see massive sell-offs, always in front of the farm labor report, or anytime they have a meeting, typically we see a sell-off. But the thing of it is that I think there's a growing awakening and awareness that they are running out of tools. They are running out of arrows in their quiver, I think, to continue to paint a narrative that is becoming increasingly poor. And so, no, I'm not surprised one bit at all. And I don't know what else she can say except to act big. And the question becomes, once you act big and start paying people money to not be productive, how do you ever stop that? How do you ever stop that injection of liquidity that keeps people feeling, okay or wealthy? So it's these are interesting times, Chris. Very, very, very interesting. And I think the Fed really doesn't have much to say anymore, except we're going big. So no, interesting times for sure.
Yeah, well, Andy, in terms of other things that are going big right now, and I see one comment in our chat window there was about this situation on the stock GameStop, where apparently, and I'm kind of catching up to speed on what's happened as it goes along. So perhaps anyone in the chat room who has updated information can chime in. But basically, there was a short squeeze, and the stock went from, it was like $18 a couple of weeks ago. Then it got up to over 200, and today it's up like $200 right now. And it's interesting. I got a lot of Twitter messages and comments saying, "Hey, are these guys going to be aware of silver?" I don't know. It would certainly make sense, and just shared a video in the chat there of what I would share with the Wall Street Reddit crowd. Andy, I mean, doesn't this thing went up 20? I think it was about 18x. Tesla's gone up 18x, and Bitcoin's up 10 to 13x. Then you have the silver profile where it's half of the 1980 high. Is there kind of interesting to think about what could conceivably happen?
Maybe you call me old school, Andy. I know you like to joke about that a lot. And when I started in this industry in 1989, the Dow Jones was 2,100. And I'll tell you, I'm 50 years old, and I'll tell you, I've learned that the more things change, the more they stay the same, with the exception of the stock market. And you have a whole generation of people who are growing up believing that those types of returns are normal, that you see casino type returns, like slot machine ringing bells type returns. And granted, it is becoming more commonplace, but here again, ask yourself what would happen if the Fed hadn't been and stopped injecting liquidity into the system. They just completely let Mother Nature take hold. All of these massive gains would be exposed for what they really are, illusionary. And for the people out there who have made these types of gains, the issue, and trying to be completely impartial, I mean, take out of the equation that I and you believe so much as we do in metals, and I own a company that sells it. Honest to God, take that out of the equation. You got to be out of your mind to not take some of this stuff off the table and put it into something so massively undervalued that is so completely and totally needed and sought after in an ever-increasing green and electric and digital world. These types of gains are not natural. I mean, they're just not, unless the laws of investing and economics are being rewritten right out from under me. And, there is a fine line between being a traditionalist and old school and getting with the technological, age, I realize that has a lot to do with it. But Mother Nature has her way of correcting things that get irrationally out of whack. And when you see these types of movements in a stock like that, it's irrational. It's a distortion due to massive money creation by the Fed, low interest rates. These things will change, and when they do, that's when you see spiritual experiences for people who have been indoctrinated and believe completely and totally that this is how markets behave. Because I can promise you, in the 45 years, the 25 years prior to the last 4 or 5, it certainly didn't work this way in my experience.
Well, Andy, speaking of spiritual experiences, I think the shorts on GameStop are getting a taste of that, because I have the chart pulled up, and on January 7th, it was floating around $18. And let's go back to the 5-day here, because it's about $42 a week ago. And then what is today? I believe is the 27th. Okay, so yesterday thing closes at about 150, and it's up 112.93% today. So after closing at 150 yesterday, which a week earlier was 40, a week before that it was 20. So now it closes at 150 and then goes up 114%. After closing at 150 is up $168.99 on the day. So let's do a little quick math here. If we take 315 divided by 18, so that's a 17 and a half bagger in about 2 weeks. What can I say? I wrote the book on silver. I mean,
which should underscore something very important as it relates to the silver short position. When you go long on something, your exposure is limited to 0. You go down to 0. You lose everything. But only to the value of the long position. But when you go short, your potential loss is unlimited. And that's, if you buy silver and it goes to 0, no one wants it, that's your loss. But in this case, this can bankrupt people and completely take away everything that they own, and as it continues to spiral. And that would, when you magnify that by what the commercial banks have been losing in 2020 on their short position, and what could happen if this were to take off, you can see in a matter of a day or 2 or a week how fast things spiral out of control when you see a massive short squeeze.
Yeah, and Andy, I believe we have the great Matt Card joining us. So while I welcome him in, we have a question for you from Carlos Danger. Andy, are you seeing a short-term run-up on physical silver premiums? And there's a follow-up question, but why don't we start there? Anything happening with the premiums right now?
Well, I'm so glad you asked that. So every week, I talk to my operations and say, what can we offer for a special for Arcadia? And his exact words to me today, well, first he tells me about some 1/10 ounce gold ox that we bought a bunch of. And he says, but you want silver, don't you? And I said, yeah, I don't want the gold 10th ox. He says, his exact words were to me, silver is getting sketchy. And so this is kind of what I've been saying all along, is that this is a marketplace. And in particular, when you see the amount of money out there, where the amount of money just made in cryptocurrencies alone dwarfs the silver market. I mean, many times over in terms of, what's out there. And if people wake up and start buying, what is abundant today becomes massively sketchy tomorrow. And so premiums will rise. Availability is now getting tighter, and it's happening, and it will happen, and it will accentuate. But it's the same thing, just like this short squeeze. It one day it's great, and the next day it completely changes. And so premiums are beginning to rise, but more importantly, product is becoming more and more challenging to get, just like that. And I knew it would, and I don't think we've seen anything yet.
Well, I think that says it all. Although fortunately, Joining me now is Matt Carr, good friend of mine, runs his own fund and a lot of options experience, very familiar with gold and silver. So Matt, thanks for joining on in. How's everything going with you today, my friend?
Oh, it's going well. Thanks for having me. It's an exciting day, plenty going on. So good time to hop on a call here.
Yeah, so Matt, you've seen the Fed announcement so far. We'll come back to GameStop. I'd love to get your thoughts on that. I know you've been looking at that, but any thoughts on the Federal Reserve?
Well, we're staying at zero as far as the eye can see here. So this is remaining easy. No real changes in asset purchases. They kind of tightened the rhetoric on the economy slowing down its improvement. So kind of giving themselves room to continue with QE and zero rates. So pretty dovish, really.
Yeah, and are you surprised we're not seeing more of a reaction in the markets today? So far, again, interesting day in silver. We had this move just plummets down, which seems completely natural, then rides back up. And Matt, I think I did send you a message when I bought some options here, and this one worked out well today. So maybe later on we'll dig into how you and I are doing some option projects and get some things up and running. But any thoughts on the silver reaction we see here?
Well, there was a big risk-off move across markets this morning, and you saw that in a lot of different equities. It certainly happened in metals. You timed your entry into that call option there in silver quite well, because there's been a bit of a reversion there, so that was a good move. But there are a lot of interesting things going on. I know when I just hopped on here, you mentioned GameStop, but really it's not just a situation of shorts putting on squeezes. The IPO market is red hot. The SPAC market, special purpose acquisition companies, is hot like we've never seen it. And that's essentially a way for people to bring businesses, companies public outside of the IPO route. So there's all sorts of things happening in different verticals that are pretty aggressive.
Yeah, I mean, it's like on one hand, we sit here, we watch silver not move too much until it finally moves, but there has to be some break point. And it's interesting to see the combination of using an online chat group where people are recognizing things. But again, on some level, people taking matters into their own hands. Andy, any thoughts on that?
Look, Chris, I think that we're not buying silver. People who are buying silver to get wealthy are missing the point. That's not what we're trying to do, and it will take off. It absolutely, most certainly will, just based upon the supply-demand fundamentals. People taking things into their own hands should be mitigating their exposure to a currency that is being debased and destroyed right in front of us. And the market that is so immediate in terms of, it's almost schizophrenic in terms of how we see the risk on, risk off play by the market daily and hourly. I think it's more along the lines of looking at this from a macro perspective, taking a big picture. There are so many ways to make money nowadays by trading this market that has such tremendous volatility. You can really make lots of money. I guess what I'm saying, and in particular respect to your comment of taking things into your own hands, is take some of the chips off the table. Not only is it, on so many levels, supply demand side, such a good investment. It's so much more inexpensive silver is than its previous 1980 peak, and all of those fundamentals that would say, hey, this is a good buy. But it's becoming really, really, really difficult to acquire. And I think as more people wake up to this, it's going to be center stage. taking chips off the table, realizing that profit is not a four-letter word, and moving it into such an undervalued asset that is so needed, and taking possession of it, removing counterparty risk, third-party risk, it's so important, and it's such a no-brainer right now. So yeah, I think there are ways to make money trading this market, trading cryptos, and a lot of your listeners are very adept at that. Just don't forget that pigs get fed and hogs get slaughtered. Take some of that profit off the table, put it in silver. It is not only tremendously utilized and growing every day and in depletion in terms of mining and in terms of above ground supply, but it's half of its 1980 price. The fundamentals, I mean, logically, there's very few things on the planet that make as much sense as buying silver right now, period. And the ability, one of the only things other than cryptos, which you can, take in a thumb drive or whatever they're called and hold it in your pocket or know your code in your head. Same thing with precious metals. You can take it out of the system, have possession of it, take possession of it, and take control of it. Be outside the matrix. And once we go to a digital dollar, which will come, a digital currency system, it'll be one of the few things that is autonomous from that system, giving you a little bit of freedom from that type of scrutiny. So, in any case, Chris, I think right now people should be taking some of the profits that they've made in this crazy market and putting some of it into silver, putting it aside and forget about it.
Andy, you have a comment here. Perhaps give us a brief thought on David Morgan said on As Good as Gold interview, said that it is 4 to 6 week on silver rounds in the United States. I'm assuming he meant 4 to 6 week delay. Is that what you are seeing?
No. I have thousands of them in stock. What it means is that when I run out of stock, it's 4 to 6 weeks. So, and that's what people don't understand is that, we're not online, so it's a little bit more difficult. When you go to some of these online sites and you type in quantity, type in 99999, and you'll see what they have very often. But the thing of it is that what is abundant today is not tomorrow. The market is too much just in time, because in order for companies to have things in stock, you got to pay for it, hedge it, and wait for it to be either sent across the Atlantic or produced for you. Now, when no one wants it, those guys are calling you and said, hey, I got a whole bunch extra. I'll sell it to you, send it to you quickly and whatever. But when everyone wants it, you may have a really flush inventory today, but one guy calls and spends $12 million and depletes 25% of your silver holdings. And then you try to call that distributor and say, hey, I need another 50,000 silver kangaroos. He says, fine, we'll have them to you the third week in February. We'll get them shipped. And that takes another 10 days to get it to you. And before you know it, it's already March 1st. So David's right. But right now I have a bunch in stock. But what does that mean? That just means once it's gone, then comes the 4 weeks.
All right. We're losing you there for a second, Andy. Although, Matt, I'll turn it over to you. Any thoughts on some of the reactions we're seeing here? Looks like nothing happening in the bond market. Stock market's down almost 1.5%, 2% on the day. What do you think there, Matt?
Yeah, I think I'd be keeping an eye on the bond market and in particular the yield curve, because it's increasingly clear we're going to have near zero rates for years. And this is quite a different story than the financial crisis, when a year out of the depths, we had a very steep yield curve. And, that feeds back into other markets because you're looking to finance things, you're looking to leverage, you're looking for yield somewhere. And it might be the case that that's manifesting itself in some of the activity we're already seeing. But when rates are low and you foresee them to be low for years and years, it can change the calculus on depreciating and valuing assets across the board.
Yeah, and Matt, we've been hearing more and more about yield curve control. Can you explain to folks what that is and if you think that's something we may be headed towards?
Yeah, that's a concept that in action, the Federal Reserve would target some nominal interest rate. So they would effectively be saying, we're not going to allow 10-year Treasury bonds to go above some arbitrary number, 2.5% or 3%, let's say. And then they would stand ready to purchase those bonds in the market such that the price couldn't fall and reflect a higher interest rate. There's some discussion that ultimately they'll undertake a policy like that. There's no way really to know if they do or what rate they would be targeting, where along the yield curve. But that's essentially what the idea is. And there was something called Operation Twist. This was after World War II, when effectively the Treasury was working with the Federal Reserve. And in action, they were targeting lower long-term rates, trying to pin them down. So it is something that we really could see.
Yeah, of course, they did that Operation Twist again in 2011. What I thought was interesting and Wall Street media didn't seem to be as excited to cover was that they also did short-term swap lines to Europe, which kind of offset. So they didn't mention that they were offsetting one half of the hedge there. So really was just outright QE, which is usually the case. Folks, if you have any questions, type them on in and we'll take a look at them, although I have one that I'd be curious to get your opinion on. Matt, maybe you can take this one first, as I am pulling up something I mentioned on the show recently. Here's the case. A hedge fund manager named Daniel Shack has settled with JPMorgan. Now, I'm digging around and been talking to a couple lawyers of what specific, if it's public, what specifically they allege, but basically if they reached a settlement and you find out they went with this argument and use the same argument, it would seem like that and the fact that there's a CFTC statement and from the Department of Justice saying hundreds of thousands of occasions, there are guilty confessions, fines have been paid. So maybe a little bit out of the realm of finance, but any thoughts on that situation and whether investors might have some options?
Well, I think it feeds directly into the question that many have about the fidelity and fairness of markets and the structure of the markets. How many times have we seen these large institutions, large funds, large banks, essentially breaking the rules and just settling for some nominal fee? I think that's part of the discordance that's actually going on right now with retail investors being frustrated. So yeah, you have to stay abreast of what the rules of the playing field are. But unfortunately, certain situations like these spoofing situations or these price rigging situations like we saw in LIBOR, these are really large derivative sets controlling trillions of dollars, how they move. And how it was dealt with, there were a couple of low-level employees that were punished, but firms just kind of settled and moved on. So I think it calls into question how we're actually dealing and enforcing rules in the marketplace. And that's really important to have a discussion around for everyone involved.
Yeah, I think so. Andy, would you like to chime in on that one?
Yeah, I think it's awful, and it continues to happen. If you look at the numbers, it's billions and billions and billions of dollars over the last several years that they've all paid in fines. And if you look at JPMorgan settling a $920 million fine, making $1 billion in profit, so still walking away with the profit for the year and still being allowed to be the primary custodian of SLV. I think it's very disingenuous at best, and these are the things that I think people are. This is why I think we are having part of the reason why we're having so much more interest by the mainstream, because these kinds of things are now becoming, I think, more understood by the general public, that the rules on the written on the playing field wall only apply for us and not for the elite.
Well, certainly does seem to be the case. And good news. And we're going to turn it over, go live to Jerome Powell. Matt, do you have any idea? Can I live stream through my channel? If someone in the comments knows whether I'm allowed to do that, type it in now. In fact, Matt, we did have a question from the great Rob Keens of Gold Silver Pros. So while I get that ready to go, maybe you could field this one. And again, if anyone knows, Rob, perhaps you can chime in. Where did your question go? And let me know if I can do that. I'm going to try for it and hope for the best. That's my new motto this year. But here we go. Matt, do you see yield curve inverting on rising inflation pressures in 2021?
Just to clarify the question for everyone, that means will short-term interest rates be higher than long-term interest rates? I think that's a really tough situation to see short-term rates rising. I think the Fed has continually said, they're going to steamroll the front end of the curve and potentially steamroll further out. And, a lot of market activity will probably do a good amount of work for them. U.S. yields are still relatively high compared to other countries, other jurisdictions. So at what point do you start to take into account the currency risk, hedge out dollar risk, and buy treasuries if you're somewhere in Europe and your Swiss bond pays 0 30 years out, or your German bond pays 0 30 years out? So at some point there has to be, some of that activity going on too. But an inversion of the curve on the short end, maybe like 10s to 30s, depending on how we issue. I know Yellen just started in Treasury, but she's talking about issuing 50-year bonds. That's one thing I've been surprised, that the United States hasn't issued 50-year or 100-year Treasuries.
I'm waiting for the 100-year. I think it's coming.
Yeah. I'm kind of surprised we haven't done it yet. You have places like Mexico and Ireland that issued 100-year bonds. So,
well, Matt,
we'll see.
You never know. It may be coming before the end of the day. So let's go live to Jerome, and we'll hear what the Fed is saying. And by any means, Matt, if you have funny comments, let me know and I'll pause it at any time.
Overall, our interest rate and balance sheet tools are providing powerful support to the economy and will continue to do so. We've also taken actions to more directly support the flow of credit in the economy, deploying our emergency lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. Although the CARES Act facilities are no longer open to new activity, our other facilities remain in place. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Thank you. I look forward to your questions.
Robust as possible.
Thank you, Gina.
I hope they let me in there for a question one day. That's on my bucket list.
Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I was hoping that you would first react to the wild ride that GameStop stock has had this week. And then secondarily, you and your colleagues have repeatedly made it clear that you really plan to use macroprudential tools as a first line of defense when it comes to financial stability risks, but your macroprudential tools primarily apply to the banks. I'm wondering what your plan is if you see some sort of large financial stability risk emanating from the non-bank financial sector in the coming months, especially as it relates to search for yield kind of activities. What do you see as the solution there? Thanks.
So on your first question, I don't want to comment on a particular company or day's market activity or things like that. It's just not really something that I would typically comment on. In terms of macroprudential policy tools, so as you know, no doubt, we rely on sort of always on through the cycle macroprudential policy tools, particularly the stress tests and also the elevated levels of liquidity and capital and also resolution planning that we impose on the largest financial institutions. We don't use time varying tests and tools as some other countries do, and we think it's a good approach because for us to use ones that are always on, because we don't really think we'd be successful in every case in picking the exact right time to intervene in markets. So that's for banks. You really asked about non-banks, the non-bank sector. And so we monitor financial conditions very broadly. And while we don't have jurisdiction over many areas in the non-bank sector, other agencies do. And so we do coordinate through the Financial Stability Oversight Council and with other agencies who have responsibility for non-bank supervision. And in fact, as you know, in the last crisis, the banking system held up fairly well so far. And the dislocations that we saw from the outsized economic and financial shock of the pandemic.
Did he just say the banking system held up really well through the last crisis? Did I catch that right?
I could have
Really
swore that they were injecting $1 trillion a night into the repo market, so, here again, take the Fed stimulus out and the Fed injection of hundreds of billions, almost trillions of dollars an evening into the repo market, and the banks would have all collapsed.
Well, fortunately, we can rewind a little. Let's see if he actually said that. Matt, did you have a comment?
No, that's exactly right. What Andy said, the repo market was coming apart in August, September of 2019, long before COVID. And the Fed's involvement there abrogated the private credit system in the repo market. They just started infusing capital directly into it. That was a direct bailout, and that was all prior to COVID. So that's totally accurate.
And while we don't have jurisdiction over many areas in the non-bank sector, other agencies do. And so we do coordinate through the Financial Stability Oversight Council and with other agencies who have responsibility for non-bank supervision. And in fact, as you know, in the last crisis, the banking system held up fairly well so far.
Okay, he really said it.
And the dislocations that we saw from the outsized economic and financial shock of the pandemic really appeared in the non-bank sector. So that's right now we are engaged in carefully examining, understanding, and thinking about what in the non-bank sector will need to be addressed in the next year or so.
By the way, I'm reading this book right now about how to improve writing style, and everything's about really short, concise, get rid of the filler words. I don't know, aside from the fact that he claimed the banking system performed great through the last crisis, I don't know anything that, Matt, could you translate? Did he actually say anything in there?
One thing that sticks out to me is he's talking about providing support outside of the banking sector. And the Fed doesn't regulate outside of the banking sector. That's one thing that sticks out to me. Two, you're starting to talk about infusing capital into different sectors. My next question to him would be, at what level of market cap is this only going to be realized by large cap companies? Is this something that private businesses are going to be able to access readily? The diffusion of that new capital is very important, and it essentially is picking winners and losers. You can have interest rates be low, but if credit availability doesn't exist for that small mom and pop business, it doesn't matter what the interest rates are. So how they
That's exactly correct.
Yeah, how they actually move forward with this is very important. He's talking about picking winners and losers, for better or worse, is what he's saying in my mind there.
Well, let's remember 130,000 small businesses are gone forever. And I will be wrong, I think, with this number, but I believe that the small business sector, small to medium-sized business, represents 40% of GDP. And you pull that out, these businesses that were hanging on by a thread, they used every cent they had. They've been broke for months. And so when you talk about picking winners and losers. It's the big companies that win and the little ones that go by the wayside. It's very scary what's happening. You can see it very clearly when you look at it in that light.
Yeah.
Matt, you mentioned, conceivably an issue about going outside of the Fed's mandate. Although, fortunately, I don't think you'll have to worry about that because they seem to be changing it on the fly here. And here, I thought this was interesting, how the Fed under Biden likely will be pushed towards addressing racial inequality and climate change, which seemed a little bit outside of the original parameters. But now we're going to solve racial inequality and climate change with more quantitative easing. Someone in the chat room asked what question I would ask Jerome. I think that's what I would go with today. Can he explain how quantitative easing will solve climate change? But let's go back and see. Maybe that's the next question.
Thank you. James Politi, FT.
Thank you so much, Michelle and Chair Powell. I had a question on fiscal policy. Last year, you consistently said that the economy needed more fiscal support, and I believe we're pleased when the $900 billion package was approved in December. We now have a new president, a new Congress. We have a weakening short-term outlook. Do you believe the economy still needs additional support on the fiscal side, and in what areas?
Thank you. So I guess I'd start by saying that the fiscal response that we've seen to this downturn has been strong, and I think we can say now that it's been sustained after the passage of the most recent act in late December. And that's really a key reason why the recovery has been as strong as it's been. Fiscal policy has been absolutely essential. When we look back on the history of this period, we'll see a strong and sustained fiscal policy response. I would add that we're, as I mentioned, a long way from a full recovery. Something like 9 million people remain unemployed as a consequence of the pandemic. That's as many people as lost their jobs at the peak of the global financial crisis and the Great Recession. Many small businesses are under pressure, and there are other needs to be addressed. And the path ahead is still pretty uncertain. So all of that said, the judgment on how much to spend and in what way is really one for Congress and the administration and not for the Fed. And these discussions are going on right now. So there's a discussion, as you know, right now around those precise questions, and that's appropriate, but not for us to play a role in talking about specific policies.
Well, we'll take a pause right there. And if you heard a sound while that was talking, Matt and Andy, I'm getting messages that apparently silver is now being discussed on the Reddit Wall Street board. So again, Yara, perhaps in the chat room, you could type it in the link to today's video where I shared at least what I would think would be helpful for anyone there to know. But with that said, Matt, any comments on the last one here?
Well, he's trying to deflect avenues of expenditure back to Congress via the fiscal mechanism. And I think we're going to see a lot of spending coming out of this Congress. So, what form does it take? What is the scale? Remains to be seen. And he's really demurring there as far as the Fed actively printing and pushing more money into different avenues of the economy. But, the Fed's a political animal itself. So we'll see if they stand pat and to what degree.
I'd also like to comment real quick, Chris, that, he talks about 9 million people still unemployed. The numbers are far greater than that. You have so many people that had businesses that bartenders, for example, the bars are closed. They're not looking for work. Look at the labor participation report, and the numbers have fallen off the cliff. So, the numbers are far worse than they're leading on. And I think you'll see this type of demanding of intervening and of stimulus until the cows come home, until an economy comes back to some semblance of what is normal. But, when you have so many of the people that ran these businesses on life support are already gone, when does it come back to normal? And how do things come back to normal when the engine of growth of small and medium-sized business has been kneecapped. And at the same time, the biggest businesses in the world have grown exponentially and made massive profits. It's a gutting of the middle class, and that's what people aren't realizing is all the stimulus in the world won't do any good. All it will do is create more addicts to government intervention and stimulus rather than incentivize people to get out there and build the economy through savings, investment, and reinvestment. Instead, it's can I put food on the table, and when's the next stimulus check coming?
Well, that does seem to be the case, and let's go back to Jerome. We'll do a couple. We'll go to the top of the hour here, and then really it's probably not healthy to listen too much of a central banker talk, but we'll take one or two more here.
Thank you. Steve Leisman.
Thank you, Mr. Chairman. I wonder if I could follow up on Gina's question here. I understand that you do address issues of valuations through macroprudential policies in the first instance, but there's a range of assets, and I know you do watch a range of assets, but from Bitcoin to corporate bonds to the stock market in general, to some of these more specific meteoric rises in stocks like GameStop, how do you address the concern that super easy monetary policy, asset purchase and zero interest rates are potentially fueling a bubble that could cause
context? The shock from the pandemic was unprecedented both in its nature and in its size, and in the amount of unemployment that it created and in the shock to economic activity. There's nothing close to it in our modern economic history. So our response was really to that, and we've done what we could first to restore market function and to provide a bit of relief with the recovery, and hopefully we'll be able to do the third thing, which is to avoid longer run damage to the economy. Our role assigned by Congress is maximum employment and stable prices, and also look after financial stability. So in a world where almost a year later we're still 9 million jobs at least, that's one way of counting. It can actually be counted much higher than that, short of maximum employment. And people are out of the labor force who were in the labor force. The real unemployment rate is close to 10% if you include people that's the labor force. It's very much appropriate that monetary policy be highly accommodative to support maximum employment and price stability, which is getting inflation back to 2% and averaging 2% over time. So on matters of financial stability, we have a framework. We don't look at one thing or two things. We look, and we made that framework public after the financial crisis so that it could be criticized and understood and we could be held accountable. And the things that we look at are we do look at asset prices. We also look at leverage in the banking system. We look at leverage in the non-banking system, which is to say corporates and households. And we look at also funding risk. And if you look at across that range of readings, they're each different, but we monitor them carefully, and I would say that financial stability vulnerabilities overall are moderate. Our overall goal is to assure that the financial system itself is resilient to shocks of all kinds, that it's strong and resilient, and that includes not just the banks, but money market funds and all different kinds of non-bank financial structures as well. So when we get to the non-financial sector, we don't have jurisdiction over that. But so I would just say that there are many things that go in, as you know, to setting asset prices. So if you look at what's really been driving asset prices really in the last couple of months.
What are the chances he finally admits it's his interest rate policy?
It isn't monetary policy. It's been expectations.
Oh, there we go. Of course, nothing to do with monetary policy, just completely unconnected. I'm sure that Tesla went up 18 times since he started his swap lines is a coincidence. Matt, did you have something to add there?
This is just an unprecedented situation with the level of QE, the reaction we've seen since the repo issue of late 2019, and it doesn't look to be abated here. I mean, this is a question of how easy they're going to be. It's a question of degree, not direction. And he's not saying anything to me with regard to tightening, even thinking about tightening. He's checking back to Congress on fiscal spending. Not yet. Not yet.
Well, why would he? Because he just explained that there's no correlation. It's completely nothing to do with what's going on. Let's hear the end of this one.
And it's also fiscal policy. Those are the news items that have been driving asset values in recent months. So I know that monetary policy does play a role there, but that's how we look at it. And I think that the connection between low interest rates and asset values is probably something that's not as tight as people think, because a lot of different factors are driving asset prices at any given time.
The indicators he looks at, it's like when his check engine light goes off, it's like he goes to the brakes looked at and then doesn't see the correlation. Although maybe market sell-off intensifies with hour until the close, Dow now down 600 points. Maybe somebody else is watching this and getting a similar reaction.
Chris, it's so disingenuous what he says. How does $900 billion in payments and $600 or $1,200 checks to people drive asset prices? It's all the low interest rates and easy money, and the Wall Street banks are able to borrow it at next to nothing and drive asset prices higher. It has absolutely nothing to do with fiscal policy whatsoever. That's just an intravenous life support type of injection into the real economy, keep people going another month or two. But I would argue his monetary policy has everything to do with what's happening in this crazy environment, with real interest rates almost at, negative 1 or 2% right now, and there's no question it's so much monetary policy and virtually nothing in the way of fiscal policy that's driving asset prices.
Well, seems to be the case. Last one before we wrap up for today, fellas. This one came out last night. Biden administration to buy enough doses to vaccinate most Americans by the end of the summer. Guessing it does not mention how that's going to be funded. Matt, do you have any insight on that, or would you care to venture a guess?
No, I don't have any insight as to what the schedule or plan behind that would be.
Andy, you want to take a stab at how this one might be funded, the 300 million vaccines?
No, but just like the way everything else is funded, they just create money, and most people think that it's just that's just how it happens. They create money, they pay for it, but someone has to pick up the bill at some point. And when they issue a 50% tax rate for the top income earners, when they jack up capital gains taxes and corporate taxes, you'll pay for these types of expenditures through taxation and spending and a tax and a massive debt on our future generations. Nothing is free. And when you get to the point where we are, where it becomes exponential, people are forgetting and neglecting to understand that there is a price tag, and that government just doesn't come up with the money. They have to come up with it somewhere, and it's through more debt and more taxes, and that's what we can expect over the next several years.
Well, that sounds about right. And fellas, just in wrapping up, Matt, can you let folks know where they can find you if people can contact you, find out a little bit more about some of the things you do?
Yeah, we're at qcipartners.com. You can email us at info@qcipartners.com.
All right, and I will get the site there pulled up in a second. And Andy, any specials going on? Anyone's looking for silver? Anything they should know? Any parting words?
Yes,
there,
absolutely. As far as specials on silver, we have 2020 silver Krugerrands that we are able to do at $3.19 over the price of silver, and silver Britannias from the United Kingdom can do at $3.09 over the price of silver in any quantity. And people can reach us at Arcadia at Miles Franklin. And thanks for letting me drop in, Chris. Always appreciate the opportunity.
Well, appreciate that, fellas. Certainly an interesting day. Maybe the prices weren't moving all that much, but hopefully this was helpful. We got a couple questions in there. I'm learning to get more in, but Matt and Andy, thanks for joining me. Will be interesting to see what the near future holds, but hit the subscribe button and the notification bell, and that way you can stay posted. And with that, we are signing off for now.